and this video will outline step-by-step what crypto investors need to do before the April 15th deadline and common errors to avoid. Let's get into it. The tax deadline is April 15th, 2026. For crypto investors, this means ensuring compliance with the IRS requirements. Crypto transactions have increasingly come under regulatory scrutiny. The IRS has implemented new reporting measures, including Form 1099-DA, which provides them with information on certain digital asset activities. Consider this scenario. You receive correspondence from the IRS indicating a discrepancy between reported crypto sales and the information they have. This could occur if your exchange reports sales proceeds via Form 1099-DA, but your tax return does not accurately reflect the cost basis. In such cases, the IRS may issue a notice proposing adjustments based on available data, placing the responsibility on you to provide accurate information. This reflects the current system of automated matching and crypto tax reporting. An error on Form 8949 could lead to further review. Preparation is key, and this video will outline step-by-step what crypto investors need to do before the April 15th deadline. We'll cover relevant forms, cost basis methods that can help minimize tax liability legally, and common errors to avoid. This is the same structured process firms like Numeratus use when helping crypto investors move from uncertainty to confident, defensible filings. The goal is to ensure accurate filing and reduce the likelihood of IRS inquiries. Let's proceed. April 15th is the filing deadline for individual tax returns. For crypto investors, this involves addressing specific IRS requirements related to digital assets. The IRS has enhanced resources, including blockchain analysis tools, to monitor crypto transactions. A key element is the question on Form 1040. At any time during 2025, did you A, receive as a reward, award, or payment for property or services, or B, sell, exchange, or otherwise dispose of a digital asset or a financial interest in a digital asset? Answering inadequately when transactions occurred can lead to complications, particularly with new reporting mechanisms in place. This is one of the first checkpoints professionals at Numeratus verify when reviewing a client's crypto activity. Central to this Form 1099-DA, similar to Form 1099-B for securities, it applies to digital assets. For the 2025 tax year, U.S.-based exchanges like Coinbase and Kraken are required to report gross proceeds from sales to the IRS. Form 1099-DA reports the total value of sales but does not include the cost basis. Taxpayers must calculate and report their cost basis on their returns. If a sale is not reported or basis is omitted, the IRS may treat proceeds as gain based on the information they received. Crypto's complexity means sales, exchanges, non-fungible tokens, and certain payments are taxable events subject to reporting. This is why firms specializing in crypto compliance like Numeratus emphasize end-to-end reconciliation rather than surface-level reporting. Let's talk about the elephant in the room. The IRS is watching, and they have a new playbook. Crypto transactions are traceable due to blockchain technology. Assuming anonymity overlooks the capabilities of analysis tools. The IRS contracts with blockchain analytic firms like Chainalysis to trace transactions. These tools can link exchange accounts to wallets and DeFi activities by analyzing on-chain data, including transfers and patterns that may indicate underreported activity. Transactions from exchanges to personal wallets or DeFi platforms are visible on public ledgers, the same data professional crypto accounting firms analyze when reconstructing histories. Additionally, Form 1099-DA standardizes reporting. Previously, the IRS used summons to obtain data from exchanges. Now, major U.S. brokers must report automatically. Here's how it works. Suppose in 2023 you bought one Bitcoin for $30,000. In 2025, you sold it for $70,000. The exchange sends a 1099-DA reporting $70,000 in proceeds. On your return, you report that sale. Subtract the $30,000 cost basis, and calculate tax on the $40,000 gain. If the sale is not reported or basis is missing, the IRS may issue a CP 2000 notice based on the proceeds, requiring you to substantiate the basis. This is a common scenario Numeratus.us resolves for clients after notices are issued. For active traders, multiple trades, such as exchanging ETH for another token, each constitute a taxable event, treated as a sale followed by a purchase. The 1099-DA reports aggregate proceeds, necessitating detailed records to compute gains. Proper accounting is required. The IRS expects cost-basis tracking for each asset. While assets can be tracked across accounts, specific identification requires documentation of individual units. This has been a long-standing rule, but new reporting makes accurate record keeping essential. Here's your solution: your 3-step crypto tax survival guide. Addressing crypto taxes requires organization. The approach is to systemize the process into 3 steps, the same framework firms like Numeratus use internally when onboarding crypto investors. The 3 steps are: gather your data, collect all transaction records from relevant platforms. Then we calculate the damage, analyze the data to determine gains, losses, and income, selecting appropriate cost basis methods. And then you report to the feds. Compile this information onto IRS forms, ensuring consistency with reported data. The framework organizes the process: data collection, computation, and submission. This gather, calculate, report model is how complex crypto activity becomes manageable. Let's walk through it. So let's start with gathering your data, building your alibi. This step involves compiling a comprehensive transaction history. Complete data is necessary for accurate calculations, and missing data is one of the most common issues Numeratus sees when clients first come in. You gotta list all your sins. Identify all platforms used for crypto activities. Centralized exchanges, Coinbase, Kraken, Binance, include any past or inactive accounts. Self-custody wallets, MetaMask, Trust Wallet, Ledger, Trezor, DeFi protocols, Uniswap, Lido, NFT marketplaces, OpenSea, Magic Eden, Blur, crypto payment platforms like BitPay or similar services. Download your complete history. Obtain transaction records from each platform covering all years since inception, as prior acquisitions affect current disposals. On exchanges, access tax or report sections for CSV exports. Some may require support requests for full histories, which can take time, something professional firms often handle on a client's behalf. For self-custody wallets, use wallet addresses with blockchain explorers like Etherscan. Tax software can automate this by importing on-chain data across chains, a process Numeratus.us regularly audits for completeness. And then we come to the new snitch, Form 1099-DA. Review Form 1099-DA from brokers. Compare gross proceeds to your records. Discrepancy require explanation. For 2025, it reports proceeds without basis. Consolidate and reconcile. Combine data from various sources, reconciling transfers between accounts, tagging them as non-taxable to avoid misclassification as disposals or income. This reconciliation step is where most errors are corrected before filing. Initiating this process early facilitates timely filing. And then we get to step number 2, the cost basis minefield. With data collected, compute tax implications using cost basis. This is where professional oversight often adds the most value. What is cost basis? Cost basis is the original value of an asset, including acquisition costs like fees. Taxable gain or loss is proceeds minus cost basis. For example, ETH bought for $2,000 plus a $15 fee has a $2,015 basis. Sold for $3,000, gain is $985. Without basis documentation, the IRS may base assessments on proceeds, a scenario Numeratus helps clients unwind retroactively. When multiple acquisitions exist, the method determines which basis applies. So here are the IRS-approved methods. Options include first in, first out, and specific identification. First in, first out assumes oldest assets are sold first. Think of a barrel where you fill it up with fish. You're going from the fish at the bottom of the barrel, not from the top of the barrel, and what you're going to sell first. So let's start with January 2024. You buy 2 Ethereum at $2,000 each. Then in June 2024, you buy 1 Ethereum at $3,000. March 2025, you sell 1.5 ETH for $6,000. Cost basis, $3,000. 1 ETH at $2,000 plus half a ETH at $1,000, all based on the January 2024 date of purchase. The gain is $3,000. Specific identification allows selection of specific units with records. Highest in, first out, or HIFO, prioritizes highest cost assets. Here's the same example but using HIFO. Cost basis is $4,000. It's $3,000 plus $1,000. The gain, $2,000. This strategy can materially reduce taxes when implemented correctly and documented, something crypto-focused firms emphasize. Methods to avoid. Average cost, not permitted for digital assets by the IRS. And then there's short-term versus long-term gains. Holding period affects the rates. Short-term, less than a year, is taxed at ordinary income rates. Long-term is greater than 1 year. Its preferential rates are 0%, 15%, and 20%. How do you calculate income? Certain receipts are ordinary income. Staking rewards and airdrops valued at fair market value on receipt, which becomes basis. Getting paid in crypto, treated as income at receipt value. Managing complex calculations such as cost basis methods and reconciliations can be challenging manually. Crypto tax software like Coinly, CoinLedger, CoinTracker, CoinTracking automates data import, gain calculations, and form generation. These tools are useful for efficiency. However, when activity spans multiple wallets, DeFi protocols, or years, firms like Numeratus combine these tools with professional review to ensure accuracy and defensibility. A link in the description if you want to book a call. Consider it. Now let's continue. Let's get to step number 3, understanding the paperwork, or what I like to call feeding the beast. Translate calculations into the IRS forms for submission. Answer the digital asset question accurately on Form 1040. Form 8949, the big list of dispositions. List each taxable transaction here, including description, date acquired, date sold, proceeds, cost basis, gain or loss, divided into short-term and long-term parts. Indicate if basis was not reported by broker. This is a frequent review point during a professional compliance check. Schedule D, the summary, aggregates totals from Form 8949, computing net gain or loss, which flows to Form 1040. Net losses up to $3,000 can offset ordinary income. Then we have Schedule 1 or Schedule C. Reporting your free money. Report income like staking rewards on Schedule 1 as other income. For business activities, use Schedule C. Accurate completion ensures consistency with IRS data. Now let's talk about the top 5 catastrophic mistakes to avoid. Ignoring dust and small trades. All transactions must be reported as automated systems detect discrepancies. Using the wrong cost basis method. Average cost is invalid. Ensure documentation supports the chosen method. This isn't willy-nilly. Forgetting to report income includes staking, airdrops, and bonuses. Mishandling transfers. Label transfers correctly to prevent misclassification. Filing late because you're scared or broke. File on time or extend with Form 4868. Extensions apply to filing, not payment. Estimate and pay by April 15. Many investors seek professional help here to avoid compounding issues. Crypto tax compliance is now a standard requirement with systems designed to facilitate reporting and verification. Address it systemically with a Gather, Calculate, Report guide. Begin by collecting histories. Use tax software for accuracy. Select appropriate cost basis methods. Complete forms consistently. For investors with complex activity, working with a crypto-focused firm like Numeratus can turn a stressful process into a controlled, repeatable one. April 15th approaches. Proactive preparation ensures compliance. With organized records, you can file confidently and focus on your investments. If this guide was helpful, like the video and subscribe for more content. If you need hands-on help reconciling, calculating, or filing your crypto activity, learn more about Numeratus in the links below and book a call, because this is the time of hyper novelty. Things aren't going to get easier. They're going to get more complex. Thanks for watching.